Today can really be categorized as the first bounce in this correction that we are in. The S&P 500 at the time of recording this video is up 1.65% today, and this is a sigh of relief, especially for the bulls. But does this bounce have legs? Are we going to continue to bounce higher from here, or is this just one of those bounces that leads to lower lows? Well, according to JP Morgan, the unraveling of the carry trade that has caused most of this downside in markets is only halfway complete. So there can still be a lot more selling to go. But this move really has been crazy from pre-market yesterday, 24 hours ago, give or take. The NASDAQ was down like 6%. The VIX hit 65. That's only ever happened during the Rona crash and the 2008 financial crisis. Like, the fear levels are up to those moments. That's kind of wild to think about. And it's even crazier to think after today's bounce, you're only down about 7% from all-time highs on the S&P 500, and the VIX hit similar levels of 65, in which you were down like 40% in 08, you were down 30% during the Rona crash. So yesterday's VIX spike was unprecedented. You've really never seen anything like that, where the fear just came all at once, and it was strong. Now, I do think some of the selling based on this yen carryover trade could be done at least in the short term until the Fed cuts rates or until the Bank of Japan raises rates. When either one of those things happens, that's when more carry trade fears could start to come out. But I do think we've priced in the vast majority of that risk. As I have said for a long time here on this channel, the biggest thing, the only thing that really matters at this point, in my personal opinion, is the labor market and the economy. I don't even think the Fed matters all too much. I don't think really anything else matters. Inflation, I don't think that matters. Inflation's dead at this point. And some of you guys are going to say the Fed doesn't matter. Well, not really, because we already know, or at least we're pricing in 50 basis points worth of cuts at September. I mean, we're going to get that. Let's just be honest. We're going to get that at this point. Like, if inflation comes in really low, great. We price in 50 basis points still. I doubt it's going to go higher than 50 basis points in September. Highly doubt that, unless you see some very weak economic data. At that point, markets are going to be in the toilet anyways because of the weak economic data. So the inflation doesn't matter unless inflation comes in hotter than expected. If inflation comes in hotter than expected, then you have a larger problem on our hands. So really, bottom line, the only thing that matters for investors is the economy. Is a recession? Are we going into one? Is the economy still doing okay? We need more clarity. The markets want more data. But in terms of today's bounce that we're seeing, if you recall, I told you we were going to bounce today, or there was a high chance that we bounced today because of the extreme levels of fear that we've seen in a very short amount of time. When the RSI gets to 30 on the SPY, you tend to bounce. Now, this does not mean the fall we've seen is irrelevant at this point. That doesn't mean we're not going lower. It just means we were likely going to bounce today regardless. Now, today we did have the balance of trade that came in at negative 73.1 billion. We were expecting negative 72.5 billion, so that was a little bit worse than expected. The RCM TIPP Economic Optimism Index came in at 44.5. We were expecting 45, so a little bit weaker there. And total household debt came in at 17.8 trillion. Last quarter, we were at 17.7 trillion. So moving up a little bit for household debt. Well, that's like $100 billion. So I guess it's not a little bit. $100 billion is a lot. But relative to the total, moving up just a little bit there. Optimism's not as good as we thought, and the balance of trade is a little bit more negative than we thought. And the balance of trade really feeds into the GDP report and the GDP estimates. So actually, after this larger deficit that was reported today, the estimate is now 2.9% for Q3 GDP. That's actually a move higher from about 2.6% just yesterday. Now, for tomorrow, we really don't have anything as far as economic data. You have IV PMIs coming out for Canada, but that's pretty much it. Some mortgage data. We do have a 10-year bond auction, actually, that's going to come out at 1 p.m. and then consumer credit change that will also come out at 3 p.m. But 10-year treasury yields right now, or auctions, they haven't been major catalyst as far as moving the markets. They can be, so that's definitely something to watch around 1 p.m. But really a slow day that we're heading into tomorrow. We do have some earnings today in after hours with Supermicro, Rivian, Airbnb, Wynn Resorts, Devon Energy, Reddit, GigaCloud Technology, Axon, Upstart, and Amgen. Tomorrow pre-market, you will have some big earnings as well with Shopify, Walt Disney, Novo Nordisk, CVS Health, Global Payments, Emerson, Aora, Lyft, Sony, and Dynatrace. I do think today in after hours with Supermicro is going to be one of the more important ones, considering the close business relationship that Supermicro and Nvidia have with each other. Although I think that we already kind of have an idea of how Supermicro earnings are going to be just because we've gotten so many semiconductor earnings already, and same for Nvidia. I'm not expecting any big surprises here, if you will. If we do get one, whether good or bad, that can definitely get the semiconductors moving, especially Nvidia, and that can have a positive or negative effect on markets. So even though big tech earnings are pretty much over with, besides Nvidia that reports in about 2 weeks, there is other companies still that can be important. We can also see today, after briefly the 2 and 10-year yield curve inversion actually uninvert, you're back inverted about 12 basis points today, and this is actually good news for markets because when you uninvert, that's when you're heading into a recession. Historically speaking, that's when you tend to get larger downside in markets. So the fact that you're actually now inverted again on the yield curve, contrary to popular belief, that's actually supporting our markets today. It's also supporting our markets that Iran said we are not looking to escalate tensions in the region. And this is something I think the markets were at least factoring in to the last couple of days, is a potential larger Middle East conflict and what that could mean for energy prices, what that could mean, you know, for stability in that region. And I do think that had some negative effect on markets. So some of those tensions kind of easing up a little bit is definitely a positive for markets today. And Dietrich writes on X, the S&P 500 is down at least 1% on Thursday, Friday, and Monday. Pretty strong returns across the board. 3 months later, you're higher 90% of the time and up nearly 10% on average. A year later, up 18 of 21 times and up 22.5% on average. So usually when you get those kind of sell-offs, 3 months later, you tend to be up quite a bit. A year later, you tend to be up double that. And just to kind of put 2024 into perspective, the average year sees a peak to trough move of 14.1% since 1980 for the S&P 500. 2024 is down 8.5% from the mid-July peak, yet still up 8.7% for the year. So this is pretty average. Now, take a listen to this individual on CNBC. He's with Goldman Sachs, and he actually believes that we're going to see a choppy market, and markets could actually still go lower from here.
Along, of course, with Mike Santoli, who remains. Peter, globally speaking, as you do, what can you tell us at this point in terms of the impact that we've seen from this unwind of the yen carry trade, how far it has to go, and what you think about the impacts it's had on markets over here?
Well, I think that the setup of this correction is important for context. Bear in mind it came after one of the strongest first halves, at least for the US equity market, that we've seen over many decades. And really since the trough of the markets that we saw last October, global equities had already risen by about a third and the Nasdaq by about a half. So we'd seen this tremendous rise. Now, a lot of complacency really built into the markets, really as a function of optimism about AI. So I think in the sense this correction was healthy and somewhat inevitable after such a long period without a pullback, particularly as you started to get some signs that the US economy was slowing. We'd already seen good evidence that that was happening in Europe and China. My feeling is that this correction, although it's stabilizing, is not yet over. We're still going to see, I think, some choppy environments in the short term as investors really start to calibrate and get more confident again about the direction of interest rates in the economy. But at the same time, I think we're not in a bear market and there are going to be some good opportunities.
All right, so a little bit of everything here. Mike mentioned earlier the multiple on the Nasdaq, for example, has come down. It's around 24 times. Is that enough to encourage some who might otherwise not have taken a chance to say, okay, fundamentally at least, this seems like a decent entry point?
Well, I think it's probably not come down enough. I mean, the US equity market broadly has moderated in valuation a little bit, but it's still right at the top of its long-term range. And that's true whether you exclude the largest tech stocks as well. Now, admittedly, lower interest rates, if they come through, and the markets are expecting that now, will help to stabilize the markets and valuations. But I think we could see a bigger shakeout in valuations yet before you really start to get, value investors seeking it out as a good correction opportunity.
Mike, we've seen in the last 24 hours quite a bit of Fed soothsaying. You have a market that has rapidly moved to price in much more in terms of rate cuts before the end of this year. And even Steve Wiesman this morning sharing from his own reporting that perhaps 50 basis points is now on the table in September. It wouldn't necessarily take a recession or even a growth scare to get there. It's just the fact that Fed's forecasts are now playing catch up to what we're seeing in the data. So how much does that matter here?
That's right. I do think solidifying around perhaps a September cut, not an emergency cut before that, and 50 basis points does make sense because the market recognizes usually that once an easing campaign begins, it's the beginning of a series. And if you look at the gap between the Fed funds rate now at 5 3/8 and where the 2-year yield is trading, it's massive. And so that's the market's way of saying Fed's a little bit late, has more to do. I think that's fine. I don't know that we can go to the historical playbooks and say, hey, here's how the market behaves in the first rate cut, because it really hasn't conformed to those patterns up to this point in terms of how we traded into the first Fed rate hike during the tightening campaign, bottoming when we were still tightening. But I do think it would take the pressure off if the consensus kind of coalesces around that idea. By the way, rate-sensitive parts of this market already responding, right? You're seeing utilities and you see home builders and REITs and things like that actually outperform.
Again, I think the most important thing of all is the economy. I think that is really going to dictate what happens with markets because that's the only thing that really matters. Geopolitical problems, sure, those come and go. Election fears, those come and go. But if we're talking about a risk of a actual bear market, I think the only thing that has that risk at this point is the economy. I don't care about a correction. Corrections are buyable. That's great. I'm just a little concerned that the economy does continue to weaken, that really stokes some of those recession fears, and that could be a much bigger problem for stocks. Now, have I sold any stocks from my portfolio? No. Have I bought some puts and profited on that? Yes. Am I buying stocks now? Not really. If there's good deals, I will. But you really have to have something attractive at this point, like very attractive at this point, for me to deploy more capital in this environment. I just think the risk to reward is not worth it. It's just not. How much upside is left in the broader S&P? Probably not much. You're still pricing in a very optimistic 2025, like a very generous 2025 at that. How much downside could be in markets still? A lot if we go into a recession. I think recession risks are only priced at like 5 or 10% right now. That means there's a potential 90%, pricing in of a recession that still needs to take place. And, that's a lot of potential downside. And I don't even think, again, a lot of this fall that we've seen recently has been recession risk. Some of it, at least the first part of this fall was, but not the last 2 days. The last 2 days was the Japanese yen carryover trade falling apart. It wasn't recession risk. And I think that's the bigger problem. But again, I expected to see a bounce. The S&P is now up over 2% at the time of recording this video. The RSI is back up to almost 40. So once we get closer to about 50, then I do think we can start to see more downside again, although being at 40 is a pretty good level, and you can also see some chop around here, potentially start to fall again. Anytime you're getting to 30 on the RSI is just a good rule of thumb. You probably don't want to be short anymore. You probably want to loosen up some of that put exposure. Okay, and this works really well for the downside, not as much to the upside. We go overbought all the time on markets, but pretty consistently, anytime you hit 30 on the RSI, on the oversold side, you tend to bounce. It's just almost a foolproof strategy. And it looks like that did work yet again. So I'm relatively bearish, I guess, on this market over the next 3, 6, 9, 12 months, but I was even expecting a bounce, right? So you want to be flexible and open with your expectations for markets. I know when people are bearish, we just want to think everything's going to crumble, coming soon. And that's not how things work. They can take a lot more time than you think. And simple principles like the SPY bounces at 30 on the RSI can serve you well, especially if you're trading this market. You know what else can serve you well if you're trading or investing in this market? Hitting that subscribe button, liking the video, because they are free 99 and they keep you informed of what's going on in our markets, when markets are about to crash, when markets are about to bottom. Keep in mind, I called this out on July 9th, 2024. So almost a month ago, I pinned this on my X account and said a 10% SPY correction is coming within the next 6 weeks. That was a very contrarian call. And that's why I want you to be careful, just expecting markets to continue to rip higher, because, in all actuality, this is just what could be a bear market bounce, right? If we do continue to fall into a bear market. But it's just one of those relief rallies that's aggressive, it's strong, it looks good, but it does not mean the coast is clear. Because let's face it, in all reality, nothing changed overnight. The only thing that changed is it looks like Iran does not want to stoke more tensions in that region. But that wasn't really what was affecting our markets to begin with. So nothing has changed. You just seen a little bit of a bounce, a big bounce over in Japan that got our markets also excited. But again, at the core of this, the same issues are still here as we had yesterday. Mark Newton says risk to reward grows favorable with signs of fear visibly on the rise. Once SPX either declines under 5119 or gets back over 5394, we can start to discuss upside targets. And apparently back on July 19th, 10 days after my call for a 10% correction, a mystery broker said they were looking for a 10-ish% correction, with pretty much citing the exact same reasons that I cited. And apparently this broker that called for a 10% correction on July 19th issues a tactical buy for the S&P 500 at 5,200 this morning, playing for a short-term bounce for now. Not an all clear, says will most likely need a retest his initial correction call. But if you just need to know when corrections are going to happen first before everyone else, just subscribe to the channel. I pinned this on my X account July 9th. Again, it was easy to see, and that was a very contrarian call at the time. With that said, CNN's Fear and Greed Index is sitting in extreme fear today at 23, which is actually surprising considering the SPY is up almost 2%. You would think markets would not be as fearful as extreme fear today. I think there's something weird going on here to be an extreme fear when the SPY has bounced 2%. And in all actuality, the SPY from its, let's call it 510 low in pre-market, you were at about 507. You've already bounced like 3.5%. So I really don't understand how you're still in extreme fear on the fear and greed index. Today, 10-year Treasury yields are up about 11.5 basis points, and this is helping to support markets as well because, simply put, when yields fall, that means people are going out and buying bonds. They're buying treasuries. When investors are buying treasuries, it's usually seen as a fear move, especially if stocks are selling off at the same time investors are buying bonds. That's not a great look. That is a rush to safety or a flight to safety, if you will, because bonds are seen as really the number one safe haven asset. So as you're seeing people selling bonds today, driving yields higher, even though yields are going higher, that's not necessarily great for stocks. It is a little bit more of a sign of at least short-term confidence in markets. Now, I do think, like I said earlier, from a technical perspective, this 100-day moving average is probably where we get stopped out on this bounce, which is right at about where we are right now. 50-day moving, 100-day moving average is at about $528.25. If we break above this into the end of the day, if we hold this level into after hours, if we hold this level tomorrow, then it's possible our stop out point on a bounce would be this 50-day moving average at about 542.79. Now, it's possible we trade between the 100-day moving average and the 50-day moving average. This $20 range or so, it's almost a 3% range. That would also be possible, but I am expecting a lot of volatility, and I don't think the selling is over with. In fact, if the economy gets worse, I don't even think the selling has started yet. If recession fears start to rise, there's going to be a lot, and I mean a lot more selling. So let me know what you think about this information down below in the comment section. I really think bottom line, what makes the most sense to me right now is obviously trading in the short term. If that's your thing, I love trading these short term moves. That's my thing. I keep stop losses tight. I get in, I get out. I'm not holding anything in overnight into the next day. If I make money on a trade, it's going to be a day trade. I'm not swing trading anything in this market because we could wake up and stocks are going to be down 3% again tomorrow, and whatever profits you had plus some are going to be gone on any upside trade. And then I think it's too risky to go into downside trades for tomorrow because markets could go up another 1 or 2%, and then you're going to get blown up on that direction. So there's really no clarity on what's coming next on either side. So I think you want to be really nimble here. Short-term trading makes a lot of sense if you keep stop losses tight and you don't just let your losses run and run and run. So that's kind of what I'm doing from a trading perspective. As far as the overall cash pile that I've been stocking up now for about a month or two, I'm just waiting. Okay, because the ultimate problem is the economy, and I think later this year that will become obvious, and I think markets will react to that, and I think that's where you get a larger down move or larger trade to the downside. Unfortunately, premiums are too high now that you've already fallen almost 8% on the S&P. Premiums are high, so there's really not too much of a trade you can actually buy that makes sense, that's longer duration, like November, December, or 2025 options. They're just too expensive right now with the VIX still where it is after seeing a 65 on the VIX just yesterday. Gonna have to give that a couple of weeks to clear out. And I think ultimately, really, November, December is probably when things start to turn really bad in the economy anyways, and or the labor market. So I think there's still some time here, and I think it's going to be very volatile until we have more clarity on the yen carryover trade, the economy, just how bad things are going to get. So let me know what you think about this information down below in the comment section. If my track record doesn't speak for itself, in, you know, maybe my opinions being somewhat accurate, well, I don't know what else to say, because we called this correction before everyone else did. Unless you're a perma bear, then obviously you did call it before me. But in terms of active investors, non-perma bears, I was the first one to call it. Let me know if there's anyone else that called it before me on July 9th. So that is it, guys. Let me know what you think about this information down below in the comment section. It's crazy. July 9th, the SPY actually did end up going up about 5 days later. And then, boop, it was over from there. So you guys have a great rest of your day, and I will see you in the next one.